Are mass layoffs on the horizon as people run out of money?
Experts like Nick Gerli, Jeff Snyder, and Joseph Wang have analyzed consumer behavior, corporate strategies, and economic trends.
In this video, we've distilled their critical insights into actionable takeaways.
First, Joseph Wang frames the current market environment as one characterized by uncertainty and complexity. Nick Gerli then reveals how mass layoffs are being anticipated. And finally, Jeff Snyder breaks down how the financial markets are waking up to economic reality. Just a quick reminder, this content is for educational purposes only and not investment advice.
Leading voice on market dynamics and economic trends.
Joseph consistently delivers sharp analysis on the forces shaping today's financial landscape. Buckle up, because he doesn't pull any punches.
Translates key indicators into actionable strategies.
Exactly. Today, we're breaking down Joseph's key points on everything from treasury yields to corporate bond spreads.
Joseph Wang frames the current market environment as one characterized by uncertainty and complexity.
Yeah, it's a bit of a roller coaster out there with new challenges popping up all the time.
Joseph highlights several key themes, including the impact of central bank policies, the outlook for economic growth, and the interplay of various market forces.
Right? And understanding these themes is crucial for navigating the current landscape.
Joseph Wang emphasizes the importance of monitoring treasury yields as a key indicator of investor sentiment and economic expectations.
Absolutely. Rising yields can signal concerns about inflation or increased borrowing, while falling yields may indicate a flight to safety.
Joseph points out that changes in treasury yields can have a ripple effect across various asset classes, influencing everything from stock prices to mortgage rates.
Exactly. It's like a financial domino effect. What starts in the bond market can quickly spread to other sectors.
Joseph Wang also discusses the significance of corporate bond spreads as a measure of credit risk and market stability.
Right? Wider spreads indicate that investors are demanding a higher premium to compensate for the risk of lending to corporations.
Joseph highlights that monitoring these spreads can provide early warning signs of potential distress in the corporate sector.
Think of it as the market's way of whispering something's not quite right with these companies' finances.
Joseph Wang suggests that while there are reasons for cautious optimism, the market faces several potential headwinds.
Exactly. We're not out of the woods yet, and a lot could still go wrong.
Joseph points to factors like rising interest rates, geopolitical tensions, and supply chain disruptions as potential risks to the outlook.
Yep, it's a cocktail of concerns that could easily spoil the party.
Joseph Wang recommends keeping a close eye on treasury yields as a barometer for market sentiment.
Right. A spike could signal a flight to safety, while a dip might indicate renewed risk appetite.
Joseph also highlights the importance of tracking corporate bond spreads to assess credit risk.
Wider spreads mean investors are getting nervous about companies' ability to repay their debts.
Today, we're examining insights from Nick Gerli, an economist who's been tracking some concerning trends in the market.
Nick is sounding the alarm about potential mass layoffs and an economic slowdown. Are people really running out of money?
Nick's analysis focuses on consumer behavior, corporate strategies, and overall economic health.
Yeah. And he's seeing some worrying signs that suggest things could get worse before they get better. Let's break down what Nick is seeing.
Nick Gerli's analysis suggests that people are running out of money and Wall Street CEOs are bracing for mass layoffs. What's the big picture?
Nick's seeing a convergence of factors that point to significant economic challenges ahead. Consumer distress and corporate austerity are major warning signs.
Are these isolated incidents, or are they part of a larger trend?
Nick argues that these are connected trends. The pressure on consumers is forcing companies to make tough decisions, including layoffs.
Nick points out that personal savings rates have plummeted while credit card debt is soaring. That's a double whammy.
Right? People are burning through their savings and racking up debt just to maintain their lifestyles.
So basically, we're living on borrowed time and borrowed money.
Pretty much. And that's not sustainable.
Nick notes that loan defaults are also on the rise, which indicates people are struggling to make payments.
Yeah. And that's a big problem for banks and lenders. It could trigger a cascade of financial problems.
So, missed payments today could lead to bigger crises tomorrow.
Exactly, it's a snowball effect.
Nick says that several Wall Street CEOs are quietly preparing for mass layoffs. What's driving that?
Nick believes they're anticipating a significant economic slowdown and are trying to cut costs in advance.
So they're basically bracing for impact.
Yep, and layoffs are often the first move when companies are trying to weather a storm.
Nick points out that companies are starting to freeze hiring and reduce investments. That's a sign they're tightening their belts.
Right? And those moves can have a ripple effect on the broader economy. Fewer jobs, less spending, slower growth.
So it's a domino effect?
Exactly. And it can be hard to stop once it starts.
Nick warns that if these trends continue, we could be heading for a significant recession. How severe could it be?
Nick's concerned it could be worse than people are expecting, with prolonged unemployment and financial hardship.
So not just a mild bump in the road.
No, Nick is worried about a more significant and lasting impact.
Nick also believes that the Federal Reserve's actions could exacerbate the problem if they raise interest rates too aggressively.
Right? Higher rates could further squeeze consumers and businesses, leading to even more layoffs and defaults.
So the Fed's trying to fix one problem, but might accidentally create another.
Exactly. It's a delicate balancing act.
So what should viewers be watching for to understand the situation Nick Gerli is describing?
Nick emphasizes keeping an eye on corporate earnings reports and layoff announcements. These are real-time indicators of economic stress.
Right? So if companies are posting losses and cutting jobs, that's a clear sign of trouble.
Exactly, and these trends often lead the broader economic indicators by a few months.
Nick also suggests paying attention to consumer spending data. If people are pulling back, that E2VFS a big red flag.
Yep. Consumer spending drives a huge chunk of the economy. If that slows down, everyone feels the pinch.
So no more impulse buys? Maybe stick to the essentials.
For now, maybe. Watching your budget is probably a smart move.
Today, we're diving into key insights from Jeff Snyder on how financial markets are increasingly reflecting underlying economic realities.
Jeff Snyder brings a unique perspective on global monetary systems, and we are here to digest it.
Today, we are going to delve into Jeff Snyder's core idea that financial markets are beginning to align with economic realities.
He suggests that the markets are waking up to the fact that there may be an economic slowdown.
Jeff Snyder emphasizes that the disinflationary pressures we're seeing aren't just about higher interest rates, but rather due to the unwinding of supply chain disruptions. What's the real story here?
Exactly. Jeff highlights that as supply chains normalize, the cost-push inflation eases, but this isn't necessarily a sign of robust economic health.
Jeff argues that financial markets are recognizing these disinflationary trends more acutely than the Fed. Why is there this divergence in perception?
The market is seeing a slowdown in global demand that is impacting inflation. Jeff makes a solid point that the bond market is pricing in weaker economic outcomes.
Jeff Snyder suggests that if the economic slowdown continues and financial conditions tighten further, we could see increased volatility in equity markets. What does this mean for investors?
A potential repricing of risk assets. It's the market's way of adjusting to a new reality where growth is not as abundant as previously believed.
Jeff also emphasizes that watching leading economic indicators will be crucial in the coming months. What indicators should viewers track and why?
Pay attention to PMI data, consumer confidence surveys, and housing market metrics. These are all key barometers that can provide early warnings of economic shifts.
Jeff Snyder suggests keeping a close eye on treasury yields, especially the 2-year and 10-year. What's the play there?
If the yield curve inverts further, it could signal increased recession risk. It's like the bond market is shouting a warning that financial markets are waking up to economic reality.
Jeff also emphasizes the importance of closely watching inflation data releases. What metrics should viewers focus on?
Pay attention to the CPI and PCE data releases. If these metrics continue to indicate persistent inflation, it might suggest the Fed will maintain its hawkish stance longer than expected.
Today, we're revisiting a conversation between Adam Taggart and economist Jeffrey Sachs.
Jeffrey Sachs is a world-renowned economist known for his work on sustainable development and advising governments around the globe.
In the interview, Sachs shared his perspective on the current economic landscape.
and he wasn't afraid to say what he thinks. He argues that current economic policies aren't cutting it, and, frankly, we need bigger changes.
The core message from Jeffrey Sachs is that we need systemic changes to address our economic challenges.
He's not just talking about tweaking a few policies here and there. Sachs is advocating for a fundamental shift in how we approach economic policy.
So, what kind of shift are we talking about?
Sachs wants to see a greater emphasis on social justice, environmental sustainability, and global cooperation.
Sounds ambitious. Is it even realistic?
Sachs acknowledges it's a tall order, but he argues that the alternative E2H5, continuing down our current path, E2H5 is far more dangerous.
So one of the big ideas from Jeffrey Sachs is that monetary policy alone can't solve our problems.
Right, Sachs says relying solely on the Fed to adjust interest rates is like trying to fix a broken leg with a Band-Aid. E2H5's just not enough.
What does he suggest instead?
Sachs calls for a more comprehensive approach that includes fiscal policy, investments in infrastructure, and addressing income inequality.
So more government spending and intervention.
Exactly. Sachs believes strategic investments can boost long-term growth and create a more equitable society.
Another point Jeffrey Sachs made was that income inequality is a massive drag on our economy.
He argues that the concentration of wealth in the hands of a few not only creates social problems, but also limits overall economic growth.
And his solution is E2H5 tax increases.
Yep, Sachs is pretty clear about this. He thinks we need higher taxes on the wealthy to fund public services and reduce inequality.
That's a bold stance. Are there any examples of this working well?
Sachs often points to Scandinavian countries where higher taxes support robust social safety nets and high standards of living.
Adam Taggart, and Jeffrey Sachs also touched on cryptocurrency, particularly Dogecoin, DOGE coin.
Sachs was pretty blunt. He doesn't see meme coins like Doge as a serious solution to our economic challenges.
Ouch, so he's not a crypto bull?
He E2H5 skeptical. Sachs argues that real change requires systemic solutions, not speculative assets.
Systemic solutions, like E2H5.
Again, Sachs circles back to policy changes, infrastructure investments, and addressing the root causes of economic inequality.
What specific predictions did Jeffrey Sachs make in the interview?
Well, he anticipates increased political instability if income inequality isn't addressed.
That sounds ominous. Anything else?
He also foresees a potential debt crisis in developing countries if global interest rates continue to rise. Basically, he's not super optimistic about the near term.
So what's the silver lining? Is there any good news?
Sachs believes that strategic investments in renewable energy and sustainable technologies could create new jobs and drive economic growth, but it requires a coordinated global effort.
Okay, so what are the big takeaways from Adam Taggart's conversation with Jeffrey Sachs?
Jeffrey thinks we need more tax revenue. A lot more. So, keep an eye on proposed tax increases and how they might affect your investments.
And if Sachs is right, where should people be putting their money?
Well, according to Jeffrey, focus on companies that can thrive even if taxes go up. Think essential services and innovative technologies.
Today, we're diving into an analysis from Trade Brigade, a channel known for its in-depth market commentary.
Trade Brigade provides analysis of short squeezes and potential market corrections. Buckle up.
Trade Brigade uses technical indicators to gauge market sentiment. What's their overall take?
Trade Brigade believes that despite the recent short squeezes, we're likely heading towards more downside. It's a roller coaster, folks.
So what's Trade Brigade's main argument?
Trade Brigade is postulating that the recent short squeezes are not signs of a healthy market, but rather temporary boosts before a more significant downside.
Trade Brigade focuses on unsustainable rallies and that markets can be in big trouble.
Exactly. Trade Brigade thinks these squeezes are creating a false sense of security, setting up traders for a fall.
So, what exactly is a short squeeze? And why does Trade Brigade think it as important right now?
Basically, Trade Brigade explains that a short squeeze happens when a stock jumps, forcing short sellers to cover their positions, which in turn pushes the price even higher.
Are these squeezes sustainable or just temporary blips?
Trade Brigade argues that these rallies are misleading. They believe it is often due to over-leveraged traders.
Beyond the short squeezes, what else is Trade Brigade seeing that points to more downside?
Trade Brigade emphasizes that decreasing volume and waning momentum suggest underlying weakness despite short-term price gains.
Are there any specific candlestick patterns that are catching their eye?
Trade Brigade mentions bearish candlestick patterns, which indicate a higher probability of price decreases.
How does investor psychology play into Trade Brigade's analysis?
Trade Brigade believes that FOMO T, fear of missing out T, is driving much of the irrational exuberance in the market right now.
So, people are jumping in just because they see prices going up.
Exactly. And Trade Brigade thinks this could be a classic sign of a market top where everyone's optimistic right before a big crash.
According to Trade Brigade, how significant could this potential downside be?
Trade Brigade warns that the market could experience a substantial correction, taking back many of the recent gains.
What sectors are most at risk, according to Trade Brigade?
Trade Brigade points to highly speculative tech stocks and meme stocks as particularly vulnerable. These sectors saw huge run-ups. They are very high risk.
What does Trade Brigade recommend for traders looking to protect themselves?
Trade Brigade suggests reducing exposure to high-risk assets and considering defensive sectors.
Any specific sectors Trade Brigade likes in a downturn?
Trade Brigade notes that traditionally defensive sectors like utilities and consumer staples tend to outperform during market downturns.
So, what should traders be watching to prepare for this potential downside that Trade Brigade talks about?
The key is to keep an eye on those short squeezes. Trade Brigade believes these squeezes are offering a deceptive sense of market strength. Use them as opportunities to strategically adjust positions.
Trade Brigade emphasized to not get caught up in the temporary enthusiasm. Got it.
Exactly. Avoid FOMO and instead plan for potential downside. Those squeezes might be the last hurrah before a significant market pullback.
Wow, what an amazing discussion we've had today.
Definitely. We had some heavyweights in the room. Trade Brigade, Jeffrey Sachs, Jeff Snyder, and Nick Gerli.
Absolutely. And they all concur on one thing. Volatility is the name of the game in today's markets.
Right. But that's where things get interesting. Trade Brigade sees volatility as a short-term hurdle, while Nick suggests it's part of a broader transition to green energy.
That's a great point, and I loved how Sachs brought attention to economic inequality as a critical issue.
And Jeff Snyder reminded us that liquidity challenges can't be overlooked. It's a multifaceted situation.
So much to unpack. If you found this insightful, hit the like button and subscribe.
Your support drives us to keep bringing you more expert analyses.
And don't miss our next video, where we dive deeper into emerging economic trends.
Thanks for watching, and we can't wait to see you next time.